Hey everybody, welcome to the channel. Hope you guys are doing well today. In this video, I'm going to introduce some of the newest farms on Polygon. We'll start off with some of the safer farms, and I'll end the video with the more risky farms. And if you guys want to learn about farms that I've talked about in the past, or you guys want to reference some of my older Polygon videos, I went ahead and consolidated all of them into a playlist for you guys, which you guys can access by clicking the upper right hand corner of your screen or clicking in the description below. And every week, or sometimes even bi-weekly, I'll send out interest rate updates across both CeFi and DeFi platforms, and oftentimes I'll also include new farms that I've discovered. These email updates are 100% free. By clicking the Substack link in the description below and entering your email address, you'll have full access to them. And in my Discord, you'll find that the various networks that support DeFi farming, they're divided into channels, and within those channels, I've gone ahead and pinned useful resources. This way, if there's a new farm or there's a new bridge, not only will you learn about it ahead of everybody else, but you'll also be able to use Discord as a reference if you ever need a link. However, if you're not into Discord, at the very least, make sure you guys give me a follow on Twitter. I think it's a great way for you guys to keep up with the industry highlights and also learn about the new farming opportunities that I'm interested in. All the relevant links can be found in the description below. With the intro out of the way, let's go ahead and dive into this video. Alright, to begin the video, let's cover Balancer and its liquidity mining incentives. My general strategy for yield farming is keeping most of my funds on farms or protocols that I feel very comfortable with. And without even doing a deep dive into looking into who the backers are, the creators are, or the team is, the market itself will do a pretty good job of identifying the safer protocols and the more risky ones. For example, protocols with the larger TVL and lower rates typically means that collectively all the market participants feel like this protocol is pretty safe, and that's why they've made the decision to deposit a large portion of their funds into the protocol. And as a result, the yields get diluted and they may move below the market average. Now, that doesn't mean that the protocol is 100% safe. Oftentimes, the savvy hackers can think of attack vectors that the team and auditors haven't thought of. And oftentimes in DeFi, it's not even a smart contract exploit that leads to people losing money. It oftentimes is an economic exploit. So with that being said, let's look at the pools that they're supporting and the yields that they're offering. The first 5 here are the incentivized pools, and they started disseminating the rewards on June 28th. By providing liquidity to those pools, you're going to get Balancer tokens, MATIC tokens, and Q tokens for the QDAI pools. And sometime in the future, you'll also see a stablecoin pool with the traditional USDC, USDT, DAI, and what they're going to add into the mix is QDAI stablecoin MAI. If you guys want to learn a little bit more about this protocol, I did talk about this in one of my more recent videos. You guys can check that video out in the playlist below or click the upper right hand corner of your screen. Unlike the pools that you guys might be accustomed to that are dual-sided, meaning that they have 2 tokens, Balancer is more like an index that people can trade in and out of. So anytime one of the tokens in the pool appreciates significantly in price, some of that token will be sold off into the other tokens to dynamically maintain the pool allocation. And just like Uniswap, people trade in and out of these pools, and that activity generates a fee that's redistributed to the liquidity providers of the pool. And just like Uniswap, you're going to be subject to impermanent loss, and this tool here helps you calculate your projected impermanent loss. If you guys want to reference this, I'll make sure to include a link in the description below for you guys. And so when you're using this, make sure that the pool weights are properly adjusted, and from there you can go ahead and simulate your projected impermanent loss by entering in the theoretical price changes in these fields. Currently, they only support volatile crypto assets for liquidity mining incentives. As I mentioned earlier, the stablecoin pools aren't coming until later. If you guys want to be notified when those are out, make sure you guys either subscribe to the newsletter or join my Discord. Personally, out of all the pools that they support here, this is probably my favorite, even though it's not incentivized. And assuming that you're not a bear, this is probably one of the safest ways to play a crypto bull market. Not only do you have healthy exposure to Bitcoin and Ethereum, but you also have exposure to a DeFi index. And what I'm thinking about doing in the near future is taking a portion of my farming profits and putting it into this pool here, because not only will I get exposure to the upside of crypto, but I'll also be able to generate a yield on it. Next up, we're going to cover Kyber's dynamic market maker protocol. You can kind of consider this the next generation automated market maker. With this newer model, they aim to have amplified liquidity pools that are more capital efficient than the traditional automated market makers that we're used to. With the current TVL that they have, these are the APYs that you can expect to get. Unlike Balancer, they already have a stablecoin pool. Unfortunately, these two pools aren't generating much yield. And I want to highlight this is APY, it's not APR. And so the APR is a little bit less than what you see here. They also have liquidity mining incentives for the Ethereum side, and you can see that the yields in some cases are a little bit larger. For example, the USD PEG stablecoin pool has an APY of 16%. And unlike the MATIC side, they have a WBT/ETH pool, and the yield here, in my opinion, is pretty respectable. Now, the downside of providing liquidity on Kyber is that they have a linear vesting period. For both the Ethereum and the Polygon side, it's 30 days. And basically, they get vested whenever you harvest your rewards. So if you harvest your rewards on a daily basis, you're going to have multiple vesting periods running concurrently. So if you want to redeem your rewards ahead of everybody else, you'll have to harvest this on a daily basis, or you could just wait until the liquidity mining rewards are over and just harvest and vest them at the same time. And in my view, 1 month is a very long time in crypto. So if the price of the KNC token goes down over time, let's say it goes down in the next few months, in that case, your realized yield is going to be a lot lower than what's displayed on the Kyber dashboard. Next up, we're going to go ahead and cover Curve protocol. Currently, they're supporting liquidity mining incentives for a stablecoin pool, a BTC pool, and a multi-asset pool that includes USD, WBTC, and Ethereum. The base rates here aren't very lucrative, but they're going to go ahead and bolster those rates by giving you guys an additional yield paid in Curve token and MATIC token. And if you want to auto compound these rewards, apeswap.finance allows you to do that on their platform. They support all the pools that they have on Curve. Or you could head over to adamant.finance and they support 2 of the 3 pools. Out of all the DeFi protocols out there, in my view, Curve is probably one of the safest, most reliable, and most transparent projects out there. So I would definitely grade this as one of the lower risk protocols. And despite having a large amount of deposits, the yields here are still pretty competitive. And I think the A-Try crypto pool here that has 33% allocated to ETH, to BTC, and stablecoins is a pretty good pool for individuals who are uncertain about which way the market's going to move. And by deploying your funds here, basically you get to hedge in case there's some downside and also have exposure in case the market moves to the upside. And while you have that exposure, you're also able to generate a yield on those assets. And their model is somewhat similar to Balancer, so if you wanted to calculate the impermanent loss, you can probably get a pretty good approximation by using this calculator here. Moving along, now we're going to go ahead and proceed to cover ApeSwap. This is probably a medium risk protocol. It expanded over from the Binance Smart Chain. It has probably one of the most active teams I've seen in DeFi, and they even have a podcast for IDOs that they host on their platform. I've done a review in the past on the Binance Smart Chain version of this protocol. If you go ahead and click the upper right hand corner of the screen, you can access that video. But here on Polygon, they got some pretty solid pairs here. Their stablecoin pair here, you have to remember that this is just the yield that's going to be paid out in both Banana and MATIC tokens, but the pool itself also generates a fee. So you're probably looking at an APR closer to 15%. And the way you can get a pretty good estimate of the annualized yield based on the fees alone is just coming over here to ApeSwap Analytics, clicking on pairs, and finding the pair that you're providing liquidity to. And you can see here for the USDC DAI pair, based on the 24-hour volume annualized, the yield's approximately 5%. And in case you're completely new to ApeSwap, this protocol is basically, in my view at least, the sushi swap of the Binance Smart Chain. They're a fork of PancakeSwap with a nuanced emission model, fee model, and even their tokenomics is very different from PancakeSwap. They have about 300 million locked on the Binance Smart Chain, and here on Polygon they have a total value locked of almost 70 million, and they've only been deployed on Polygon for the last week or two. Next up, we have ApeRocket, which is working very closely with ApeSwap. In fact, their IDO was hosted on ApeSwap, and all the LP pairs that they have are sourced from ApeSwap's AMM. The yield is paid out in their native token, PSpace, and if you go ahead and stake your PSpace, you actually get a portion of the revenue that they collect paid out in Ethereum. And this is just the initial pools that they're going to launch with. I'm sure they're going to add more pools in the future. For example, I could definitely see them adding a stablecoin pool. So I would definitely add this to your list of auto-compounding protocols, because even if you're not into the PSpace token, you could still benefit short-term by collecting massive yield from one of your most favorite pairs. And to end the video, we have PolyCrystal. In my view, this is probably one of the most risky farms out there. And that's because this protocol is very new. Total value locked is only about 26 million. And oftentimes this number can be inflated for newer protocols because in the initial stages, they haven't emitted a lot of their native token and farmers haven't begun to dump their tokens. So with very thin liquidity, the token sits artificially inflated. But what gave me some confidence was the fact that they decided to partner with apeswap, and all the liquidity that you see here is sourced from apeswap. But since you're depositing your LP into their smart contracts, even if apeswap doesn't do anything malicious, your funds are still at risk because your LP tokens reside in PolyCrystal's smart contracts. But if you're open to taking the risk, they have some really solid pools here. Unfortunately, a lot of them have deposit fees of 2 to 5%. Typically, when it comes to these higher risk protocols, I don't ape into them unless I can make back the deposit fee within a day. But if you're into pursuing these risk adjusted returns, these are the highest yields you're going to see for a lot of these pairs here. And to offset some of their inflation, they have these crystal pools. So by depositing your crystals in these pools, you can generate USDC or any of these other crypto assets that they support. And if you're worried about impermanent loss, you can check out their gem section where you can deposit into single-sided pools. But just like the dual-sided pools, you're going to be subjected to a deposit fee. And if you're into farming with stablecoins, it might be a good opportunity for you guys to enter in. For the next 24 hours, they're reducing the fees by 50%, and they're also increasing the gem multipliers by 2x. I was fortunate enough to buy banana when it was less than $1, and I also sold some profits around $10 to $12. And so what I've been doing is taking my profits in banana and depositing them in various LPs across Polygon and also the Binance Smart Chain. And just with the money that I have on this protocol alone, I'm making anywhere between $100 to $200 a day. Personally, I'm bullish for the remainder of 2021, so I don't mind getting exposure to volatile assets. And my strategy while the market chops around is basically to maximize my farming rewards and to use those farming rewards to buy even more crypto assets. Back in 2020, I followed a similar strategy, and on some of my farms, I was earning like $100 to $200 a day, and some of those funds that I redistributed into other tokens ended up going up 10 to 20x. So what I'm trying to say is that you may be earning a certain portion today, but assuming that you make the right moves and the market goes up in the coming months, the $100 to $200 I'm making on this farm could potentially turn into $1,000 to $2,000. And the nice thing now is that with Polygon, the fees are so low, even if you're earning a small sum of $5 to $15 to $20 a day, you can still apply a lot of the strategies that I'm using. So depending on what your risk appetite is, what your market outlook is, every few days you can take your farming rewards and convert them into things like the DPI or put them in the balancer pool, maybe even keep 10 to 20% in stables. This way it's almost like you're constructing a yield generating index, because as you're allocating to these various assets and you're redeploying them into DeFi protocols, they're going to continue to generate a yield for you. And if you're looking to expanding your knowledge base about DeFi and also about these strategies that you can deploy to maximize your returns, you can basically learn everything for free on the web, and you can even learn through dialogue by joining my Discord channel. But if you're interested in following my moves in real time, I do have a Patreon service for $20 a month that allows you to access all the private Discord channels I have, and it also provides you a free subscription to my paid newsletter. But if you don't have the time to go through all the content on the tube or go through the Discord channel and you want to expedite your learning to quickly leverage the benefits and the opportunities offered by DeFi, I do have higher tiers that allow you to get one-on-one access with me. And with just a couple conversations, I'll make sure that you're armed with the fundamentals you need to thrive in the market. If you feel like any of the services would benefit you, make sure you guys go ahead and click the Patreon link in the description below. Well, that pretty much wraps things up. I hope you guys enjoyed this video. This is CryptoOneStop signing out. I'll talk to you folks next time.